Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to the 11th episode of our InvesTips from the CIO's Desk series. I'm Steve Brice, Standard Chartered Bank's Global Chief Investment Officer and the host for this series. In the last episode, we talked about generating income from equities. Today, I want to broaden this out to talk about the role of dividend equities, even if income generation is not a primary objective. Now, there are three reasons to consider dividend equities even if you're not focused on income generation. First, the importance of dividends to long-term returns. Now, assuming if dividends are reinvested, that is, you take the dividend and use that to buy more shares in the company or the index that you're tracking, then this makes a dramatic difference to long-term returns. Hartford Funds shows this in a report that they released recently. They showed that a $10,000 investment in 1960 in the US S&P 500 index would have turned into almost $800,000 by the end of 2023. Not too shabby. However, once you take into account dividends and assume that these are reinvested as you go along, then this return goes up to over $5 million. And this is for the market as a whole. The second point relates to relative returns. So another study looks at the returns of different stocks based on their dividend yield and shows that stocks with higher dividend yields outperform those with lower dividend yields more often. The third point is that higher dividend yielding stocks generally have lower volatility. This, together with the fact that higher dividend stocks pay you more to be patient, means you're less likely to give into your behavioral biases and sell at exactly the wrong time. Selling at exactly the wrong time is a key reason that most individual investors underperform the funds that they invest in. Now, we're not saying that all your equity portfolio should be in high dividend yielding equities, because there will be times when they significantly underperform. However, it argues for at least a portion of your portfolio to be diverted from the high-flying, sexier growth stocks into this space. So that's all we have time for today. I hope you see that having high dividend yielding equities in your portfolio makes sense, even if you're not looking for income itself. In the next episode, we'll take a step back from investing and talk about the importance of insurance. Thanks again, and I look forward to catching up with you then.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.